Hi everyone, welcome to SRV Academy of Accounts. Here all my preparations and presentations are only an exam point of view. Follow my regular classes and get more marks in your semester exam. Subject Income Tax Law and Practice. Chapter Income from Capital Gain, and today's topic Long Term Capital Gain, and class 4. And today we are going to see yet another two more important problems in capital gain income. Okay, let's go. First I read the question, listen carefully. Mr. X acquired a residential house property on 15/5/2008 for rupees 4,50,000. He renovated it during 2014 and 15 for rupees 3 lakhs. He sold the residential house on 31/1/2023 for rupees 32 lakh, for which paid a commission of rupees 25,000. He bought another residential house on 1/2/23 for rupees 10 lakh. Before we work out the answer, we should find the given problem. It belongs to the short-term capital assets or long-term capital assets. How we are going to classify this problem belong to short-term or long-term? The based on the assets holding period. Yes, assets held by an assessee above 3 years, we say long-term capital asset. Assets held by an assessee within 3 years, we are going to say short-term capital assets. Yes, the holding period between the date of purchase and date of sale. So we are going to treat it as a long-term, okay? And we don't have any workings because the assets, it was acquired after 1/4/2001. Asset, it was purchased after 1/4/2001. So directly we go to the now problem and write down the heading computation of long-term capital gain for the previous year 22 and 23. Here we divided 3 columns. The first column particulars and second column amount, third column also amount. So the format start with selling price. Sale price, the given how much? 32 lakhs, and less selling expenses 25,000. Your balance we called a net consideration. How much? 31,75,000. Followed these less cost of index. So you know the cost of index. The cost of index nothing but finding the present value of past investment. Okay, and just we are going to find index cost of acquisition. Yes, and what is the formula for index cost of acquisition? Cost of acquisition into CII for the previous year divided by CII year of purchase. So as per the given problem, 4,50,000 is the cost of acquisition into 331, the value of CII, divided by 137, then CII year of purchase. And what is the index cost of acquisition value? 10,87,226. Next followed by index cost of improvement. What is the formula? Cost of improvement into CII for previous year divided by CII of the year of improvement, and the value is given 3 lakhs into 331 divided by year of improvement index price and 214. And here what is the cost of improvement? And 4,13,715. You add both the value, and what is the total? And total is called a 15,976. You deduct out of net consideration the balance we called a long-term capital gain. Here how much? 16,74,024. And next followed by less deduction under section 54 or exemption under section 54, and purchase of another new house. The reinvestment of capital assets. How much here? The 10 lakhs. And you deduct out of long-term capital gain the balance we called a taxable income from long-term capital gain, and 6,74,024. The question number 2 today's session. Mr. Govind gives the following particulars about the assets sold during the year 22-23. The particulars: jewelry, house and listed debenture. And selling price is given jewelry 3 lakhs, house 15 lakhs, listed debenture 2 lakhs. Selling expenses, the respectively 4,500, 20,000, 1,000, and date of purchase 1/12/1978 for jewelry, 1/12/2007 house property, 1/12/2012 listed debenture. The cost of purchase 12,000 rupees for jewellery, 75,000 house property and 50,000 listed debenture. The fair market value as on 1/4/2001, 20,000 for jewellery and house property and listed debentures. There is no fair market value. And CII cost inflation index for 2001-2002 100 and 2007-2008 129 and 2012 and 13 200 and 22-23 our previous year 331. Calculate the amount of capital gain. And same before we work out the problem. First we want to find out the given the capital assets belong to short term or long term. You know how we are going to classify the short term or long term? So simply say the holding period, any capital assets held by above 3 years, we say long term. Below 3 years, we are going to say short term. Here see the jewellery when it was purchased 1978 and year of sale the previous year 22-23. So as simply the above 3 years long term. And take the house property when it was purchased 2007 1/12/2007 and year of sale 22-23. So the holding period above 3 years. So we take it as a long term. And take it as a listed debenture when it was purchased 1/12/2012 and date of sale the previous year 22-23. And here holding period listed debentures about 1 year we say the long term. So here all three jewellery, house property and listed debenture, all three capital assets belongs to the long term capital assets. Start with working note. Calculation of cost of acquisition jewellery. Why we have working note here? Because this capital asset it was purchased on or before 1/4/2001. Working note number 1, calculation of cost of acquisition of jewellery. Next, cost of acquisition before 1/4/2001, the price is given 12,000. Next, add improvement before 1/4/2001. So, in this problem nil. And what is the total? 12,000. And fair market value on 1/4/2001, 20,000 is given. And next, you compare these two values, whichever is higher. The higher value is 20,000. That 20,000 we consider as a cost of acquisition. Okay. Write down the heading like this: computation of long-term capital gain for the previous year 22-23. Here we may divide the 4 columns. First column particular, second column jewellery, third column house, and fourth column debenture. Start with the sale price. The jewellery is given 3 lakhs, house 15 lakhs, debenture what about 2 lakhs. And less selling expenses 4,500, 20,000 house property and debentures 1,000. And remaining balance we call the net consideration 2,95,500 and 14,80,000 and 1,99,000. And followed by the index cost of acquisition and finding the present value of past investment. What is the formula? The cost of acquisition into CII of the previous year divided by CII of the year of purchase. And first go to the jewellery and 20,000 into 331 divided by 100 and value is 66,200. And next house 75,000 cost of acquisition in 2007 and current year previous year CII index 331 divided by 129 value is 1,92,442. And next debenture 50,000 cost of acquisition into CII for the previous year 331 divided by year of purchase CII 200 and 82,715. Deduct the values out of net consideration, the balance we called a long term capital gain. So 2,95,500 net consideration and minus 66,200, the balance we call the long term capital gain of jewellery 2,29,300. Same, what about house? 12,87,558. And what about debentures? 1,16,215. 1,16,215. So this is the long term capital gain for jewellery 2,29,300, house 12,87,558, debenture 1,16,215. Now we are at the end of today's session. Dear students, I hope you have very much confident about today the computation of capital gain in both problems. So stay connected, watch my more videos. Thank you. Bye bye.